Good morning and welcome to another Five with Fitz. I've been doing this a long time and I can only grin ear to ear this morning. The current market action is so predictable, it is almost laughable if you know what to look for, and we do. In fact, it's like an old country dance song that you play backwards. You know the one, the dog comes home, the tractor works, the fields plow themselves, and the truck won't break down. Anyway, all joshing aside, don't take your eye off the ball. According to FactSet, 86% of the S&P 500 companies that have reported so far, 86% have turned in positive EPS surprises, while 84% of them have reported positive revenue surprises. What's more, the blended growth rate is 8.5%, which if that holds through earnings season, I personally think it's going to go a little higher, but if it holds through earnings season, it will be the ninth consecutive quarter of growth. And that's important as an investor, which is why I won't pull any punches this morning. If you're scared, skeptical, or just plain uncertain about what's happening, you are not alone. I get it, right? But here's the thing I want you to internalize any way you have to. History shows very, very clearly that the markets are great at making you uncomfortable in the short term if you're in them, but the very best in the world at making you uncomfortable longer term if you're not. Since 1871, the market have had a very pronounced upside bias, and that's what you want to focus on if you're an investor. If you're a trader, fine, make money hand over fist from all the volatility. If you're an investor, use that same volatility to your advantage. Here's my playbook today. Number one, EPS, schmEPS. Musk builds a new industry every quarter. Now, Tesla, of course, reported earnings, right? Revenue came in at $28.1 billion, up 12% year over year, beating analyst expectations for, 26.37 billion or so. Earnings per share, however, were just 50 cents adjusted versus 54 expected. Now, right on cue, and again, very predictably, the spreadsheet gang is fixated on tariffs, policy uncertainty, rising competition, slower deliveries, European softness, blah, 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 aka the stuff that everybody sees. Now, Keith's rule of the back page applies in spades. We have talked about this before, but if you're just joining us, here's the skinny. If there's one thing I've learned in 45 plus years I've been involved in global markets, hard to believe, but yes, 45 plus years at this point, it is that the biggest, best, and most profitable stories are almost always found where very few people are looking, on the back page. If it hits the headlines, it's too late. Tesla's results are a case in point. The company posted record quarterly revenue and $1 billion in energy profit from its energy generation and storage division, which grew 44% year over year to $3.4 billion. I want you to internalize that for a moment. Really take a deep breath and internalize it. That is roughly a quarter of total company revenue now, exactly as I suggested it would be a few years ago when more than a few people laughed in my face for saying as much. Now, Elon also said that Tesla expects to have no safety drivers in large parts of Austin by year end, a milestone that could massively accelerate FSD validation and data scaling. Meanwhile, cash and investments rose $4.9 billion to a record $41.6 billion. That's 24% up year over year, giving Tesla enough firepower to self-fund, folks, self-fund Robotaxi, Optimus, and production expansion with no need whatsoever to pass the hat around at Wall Street. And keep in mind that all of this has happened while Uncle Elon and the team have been developing unsupervised self-driving, a humanoid robot, a super app, space program, tunneling, and more. Now, even Tesla's services and other business is now lifetime profitable on a gross margin basis, setting a record at 10.5%. I've told you before until I was blue in the face, this reminds me of Apple and its services introduction in 2014, and I said it would not be long before this happened. So here we are. Now, the other thing I want to bring to your attention is the company just logged one crash per 6.36 million miles in Q3. It will not be long before your insurance company jacks your premiums if you want to drive instead of letting the car drive. But that's a story for another time. And last nor least, Musk just said that Optimus will be the best surgeon on the planet, something I've been insisting would be the case for years. In fact, he described Optimus as having, quote, fine motor control suitable for medical and manufacturing environments. And not coincidentally, called it a $1 trillion opportunity hiding in plain sight, almost word for word what I said a while back. So great validation. Anyway, I'm not a genius. I could have easily been wrong, but it's wonderful to hear his alignment with mine or mine with his. I don't, whichever order you want to take it in. But there is no word on what I call proxy tourism yet. But given Neuralink's progress, my guess is that's not far away either, and you're hearing it here first. I see a future very close by where you'll be able to load yourself into a robot, then visit, work, walk, and otherwise live life remotely. You know what to do when it comes to Tesla shares. Keith's investing tip in this department: earnings have deteriorated to the point where they're a sideshow and a badly run circus. Wall Street's always focused on the short-term EPS miss for any company, but that's just noise. The signal is almost always hiding in plain sight on the back page, and that's what you want to focus on as an investor. 2, so why is Tesla stock dropping? All right, that's the logical question on the minds of many this morning. Well, let me lay it out for you. This is the oldest game in the book. Wall Street's apex predators count on the fact that most of the investing public does not understand what I'm about to share with you. So pay attention. They know that Joe and Joanne average will buy into good earnings. So they, the big money predators, sell. Now remember, every buyer has a seller, something we've talked about many, many times. And if you're still not putting 2 and 2 together, in other words, Wall Street knows that your FOMO is their exit. What's more, they also know that a twofer is there when they see one, right? That's why they, after getting you to buy, they induce selling hard enough that all the fresh buyers get blown out again by running the stops. That's a nasty sport, meaning that Wall Street's traders immediately drive prices so low that they're low enough to fleece all the weak money out, particularly those who think they're being smart by placing trailing stops to protect their sparkling new FOMO purchased shares. Anyway, sorry to be so blunt, but now you know how the game is played. The average investor is playing stocks, but Wall Street is playing the investing public. It's not the same thing, and it's not personal. It's their job. So do not fall for it. Instead, use investing tactics that take away Wall Street's advantage. Tactics like those I regularly share with the One Bar Head family. Something as simple as DCA, dollar cost averaging, works wonders in this department. Now scratch that. Especially in this department. To paraphrase Uncle B, as in Warren Buffett, Wall Street is simply a mechanism for transferring money from the impatient to the patient. So an investing tip in this department: know who you are, or Wall Street will figure that out for you. Usually, I might add, when you least expect it. Number 3 today, the real killer app. GM, yep, those guys, made headlines yesterday talking about the company's desire to field a car that, quote, knows you by 2028. Let that sink in. By 2028. Contrast that with what Tesla CEO Uncle Elon said yesterday. Quote, here's the thing. The simple killer app is if you can text in the car. If we get unsupervised FSD to be so good that you can text and drive, everybody will buy the car. I'm 100% confident we can make this happen, end quote. Now, I agree with him. I think, I may not own enough shares. That's the only thing that's going through my mind this morning. Now, here's a trade idea. Not investing idea, a trade idea. Deep in the money calls could be a great way to augment core Tesla shares you already own, or any other company if you want to use a strategy, particularly if you want a more cash efficient way to control a bigger slice of the pie. Leaps 2. If you don't know what those are, don't try to follow along. Learn first, practice, paper trade, then go for the gold. Number 4 today, AI is the number 1 reason customers are signing new deals. Contrary to what many will think, there's more to what's happening than just Tesla today. Case in point, German software giant SAP reported Q3 revenue of 9.08 billion euros, up 7% year over year, with cloud revenue jumping 22%, thanks of course to booming AI demand. Now, CEO Christian Klein said that AI is now the number 1 reason customers are signing new deals. And by the end of Q4, 85% of SAP's 2026 revenue will already be locked in. That is as good a visibility statement as you will find anywhere in enterprise tech, folks. The official story is that shares still dropped about 2.5% on the news because guidance came in at the low end of expectations. But based on what I've just explained in number 3 today, now you know the real reason. Again, don't fall for it. Be intelligent. Be smart about it. And finally, number 5, Uncle Sam goes quantum. Now, reports this morning suggest that the U.S. government may soon take equity stakes in several leading quantum computing companies, including ionq, Rigetti, D-Wave Quantum, as part of a new Commerce Department initiative to fund critical technology. Right on cue, and respectfully so, in my humble opinion. Here's why. If China beats the U.S. to the punch, it is game over for our financial system, for our national security, data, privacy, and more. Now, is this scary? No doubt about it. But also, in the same breath, one of the biggest single investing opportunities in recorded human history. At the risk of sounding like a broken record, every business on the planet will adapt, adopt, or die. So, simply invest accordingly. Speaking of which, the right quantum computing companies, I'm so convinced that this is going to happen, could make Palantir look like child's play in a few years' time. And that's saying something, considering that Palantir has long been a fave and it's returned nearly 2,000% since it went public via a direct listing. Now, if you want some help staying ahead of the next great run, I will be here. People regularly tell me that what I share here in the 5 with Fitz and the more detailed research I share with the One Bar Head family has changed their lives and their financial future forever. Now, I'd hate to see you miss that train if that's a concern you have. So, you can learn more anytime you want. I'm not going anywhere. But what I want you to understand this morning, as we've talked about it, is buy the best, ignore the rest. It's simple as that. Today's bottom line is along similar lines. Your job as an investor isn't to guess where the markets go next. It is to find great companies and recognize the signals needed to get you and your money there first. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow. Thanks for watching.